Hello and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching. And Iran says it has struck 2 ships in the Strait of Hormuz after the US military began strikes against multiple targets in Iran. This comes after US President Trump warned that American forces would strike Iran again if no peace deal is secured, going on to say we're going to be attacking them very hard. Well, overnight, the US military targeted air defense and radar sites around the strait after a US attack helicopter was downed near the strategic waterway. Iran responded with missile and drone attacks on US bases in Jordan, Kuwait and Bahrain, with reports of little significant damage. Meanwhile, in the US, consumer inflation increased 4.2% in the 12 months through to May, its fastest pace in 3 years, boosted by surging energy prices fueled by the conflict. And excluding the volatile food and energy components, core CPI increased 2.9% year on year. Petrol prices accelerated 7% over the month to be up 40% from a year ago. And US Treasury yields were mixed following the data and the escalation of tensions in the Middle East. The 2-year at 4.13, the 10-year at 4.55. Aussie 3-year government bond yields at 4.5%, the 10-year at 4.9%. And a quick look at currencies, which we're going to get into in a little bit more detail. The Aussie holding at 70.1 US cents. Let's get more then with Nick Twidale from ATFX, who joins me now. So I guess the biggest question is what this inflation read means for the overall greenback.
I think so, and I don't think it changes really much what we're thinking after last week's jobs numbers. Even though we've got a slightly lower core number, that 4.2% year on year is huge. I think it really does lock in a rate hike for the Fed. How happy the Fed are with that and the White House is, I'm not too sure. But markets are pricing, I think we're up to about 75% priced in for December now. So I think that's why we're seeing strength in the dollar, and I think that's going to continue because I don't think that number last night did anything to dispel any fears that we're going to see a hike from the Fed.
All right, so what does that mean for the Aussie? Is it just going to hold around 70?
I think we're going to see a little bit more downside. A lot of it's going to have to do with what we're seeing in the Middle East. If we see this conflict escalate again, at the moment markets they're kind of calling it a bit. We've seen a little bit of a rebound in the start of the Asian session. I think what we heard from Trump, we've heard a fair few times. If it does escalate, then I think the Aussie takes a big hit. I think we've drifted under that 70 cents level. As you can see there, we broke down through what was a key sort of longer term trend line, targeting now maybe down towards that 68, 37, 200-day moving average. A lot of the next move will have to do what we see in the Middle East. But if we see an escalation in strikes today, Aussie should get hit and fairly hard.
All right, what about the euro, particularly if we are going to see a rate hike from the Fed?
Well, we are. I think it's 25 basis points is from the ECB is firmly priced in. The forward guidance is going to be very important. I think if we go, we're going to hear from them that they're going to just say we're looking at data. If it's just data, I think that kind of disappoints a little bit. I think some of the bulls out there will be looking for a more hawkish indication from Christine Lagarde. That could see euro rally. But as you can see from the technicals here, we're sitting on another good technical line, which is great for traders moving into this ECB call. So anything not too hawkish could see a break of that level. We're only 25 points off the support level at the moment. And it opens the way back up to maybe hit those annual lows down around about 114, the figure.
The Aussie dollar, I've noted, has held its gains against the yen. China's trade balance a little bit higher than expected. What about the yen to the US dollar?
So we're in an interesting spot. We have been for a number of months now, haven't we? So we're grinding higher on those interest rate fundamentals. We know the Bank of Japan are around. If you're looking at the price action on some of the shorter term charts, you can see that there feels like there's some smoothing action in the market. We're very close to those annual highs. So it wouldn't surprise me if over the next couple of days we see a little bit of more aggressive action from the Bank of Japan. But for the moment, fundamentals are pointing that it's going to continue to grind higher. And that chart shows it almost perfectly over the last sort of like couple of weeks. It's just been gradually moving up. Normally when we get this, as you can see from late April, we could get a bit of a shock. So one of the trades I was looking at is actually euro yen. If we get a less hawkish ECB and you can get into a short euro yen position and then it's backed up by a bit of intervention, there could be 300 or 400 nice points in that fairly quickly.
That's a big jump. All right, so the British pound, I'm reading, is hawkish for all the wrong reasons. Do you agree?
Yeah, things aren't looking particularly well, and that could be said, I think, for a lot of the central banks and currencies at the moment, because we're pricing in these inflationary concerns, but then a lot of people are looking back to where we got before the conflict, and you're saying, well, things weren't looking particularly great here anyway. And so I think for a lot of the central banks and for the currencies as well, we're looking for them to move higher, but then looking into the future, things could really come down quite hard. It could be said for the US economy as well, although their numbers have been more resilient. So for sterling, I think it really is a sell rallies environment for cable in particular.
Yeah. All right, let's get to the big one, gold, and what we're seeing there, particularly because, as we know, we just continue to see more headlines about whether or not the conflict is going to be resolved or not.
Yeah, it's been an interesting dilemma with gold. Like, all we've seen really since the start of the conflict is gold coming off. And you'd normally be expecting safe haven trades for gold to accelerate and maybe move back to that 5,600 level. But even overnight, as you can see from the chart there, we got a really good break of that technical. That's a longer term technical support line. That went 4.5%. We're down, we touched just above $4,000. We've actually just bounced a little bit higher, back up $100, which used to be a lot, but now it seems like just a minor couple of hours intraday move in gold. But you have to trade what you see when you're trading gold at the moment. And similar to the move up that we saw in the first couple of months of the year, there wasn't any real good fundamental explanation. A lot of people were saying it was geopolitical concerns that were driving it higher. Now, we couldn't get any more deeper geopolitical concerns than the war in the Middle East, and it's just come off about 25%. So we've got to trade what we see. Yes, we've got a higher dollar. Yes, we've got higher US yields, but whether it justifies the moves we've seen in gold, I'm not sure. Whether it's kind of a resettling of those drastic moves that we saw up earlier in the year. But for now, it's definitely a sell rallies environment.
So what's the next litmus test that you see for currency traders now we've got China data, US inflation out of the way?
Well, I think looking forward, we've got to be pricing in what we're going to see from the central banks moving forward. And we're going to be data dependent. That comes probably secondary to whatever's going on in the Middle East. The moves that we're seeing in currencies and of course in oil and of course in gold have all come from geopolitical concerns. It would be nice to move back to fundamentals, and we kind of did briefly on the non-farm payrolls on Friday. But until we get this out of the way, or we get some sort of certainty, and I think the market's really craving certainty on what's going to happen in the Middle East, until we get that, we're going to see these intraday moves up and down in currencies and in other products. But then we're going to go back to looking at fundamentals, and at the moment I think fundamentals are probably pointing for stronger dollar, certainly over the medium term. But as I said, once this calms down, then we're going to be examining the numbers to see if inflation can come down, if jobs markets are going to get hit. It could be a crazy few months ahead of us.
And it certainly seems like the RBA is going to stay on hold next week.
Well, I think so, yeah. And you know, once again, we're seeing volatility with all the central banks. But yeah, I think the RBA has to stay on hold. We've had a couple of bad or lower number hits, probably good for some of us if we're in mortgage holders. So I think it's going to be wait and see from the RBA. But certainly, I can't see them moving again next week.
All right, Nick, always a pleasure. Thank you.
Thank you.
Nick Twidale from ATFX. That does it for this edition of The Trade. Be sure to join us next time.